SoFi stocks down like 40% since the summer. Why? Because Wall Street keeps hitting it with analyst reports that say it's basically an overvalued bank. And they are not just wrong, they are on the wrong planet. And I want to show you not some sort of hype, but the actual facts, the actual data. And then you can agree or disagree with me. But either way, by the end of this, you'll be much smarter. And I will also walk you through simple trade that could make you 20% in about a month, 150% over the year. So you might want to stick around till the end and smash the you-know-what. Before we jump into this and look at the miserable SoFi chart here, I would like you to be generous to yourself. Invest 1 hour of your time to learn how I and investment bankers and family offices and hedge funds trade one strategy, 3 rules, takes less than an hour a day. It's not particularly complicated, honestly. Anybody can learn this, and we give you the full rule book for free on Tuesday. That's in less than 24 hours from when I'm recording this. Go to felixfriends.org/webinar, grab one of those free spots, and it'll be live. You can ask me questions. We'll do some live trading together. Heck, we might even trade SoFi together. So come and sign up. felixfriends.org/webinar. That's where it's at. So shall we dive into this? I think we should probably dive into this after you have signed up. Yeah, felixfriends.org/webinar. And this is from Morgan Stanley's analyst report. I've just screenshotted it. I've got a full report here. And they are saying the stock now trades at bloody, bloody, blah, but SoFi should be valued like a bank. And they're looking at a 1.3 times basically price to book. Can we have a pen? Price to book multiple here, which gives a $5 value for the bank, and then they add $2 for the tech platform. And so they come up with a price target of $7, 1% upside from current levels. Now, what are they comparing against here, Morgan Stanley? Well, I saw this on Twitter. X, sorry, Elon. Wouldn't want to, misbrand you now. And it says like fintechs start with a problem they're trying to solve and obsessively focus. And it's an NPS score, which SoFi has a 90 on out of 100. What the heck's NPS? NPS is like the gold standard for customer loyalty. Bain's, the lovely, friendly consultants that care about the world. Was it Mitt Romney? Wasn't he the Bain's founder or something like that? Anyway, and basically millions of companies use this, and it basically tells you, is your product good? Your customers like you? Do they loathe you? And look at this. SoFi, 90. Goldman Sachs, 20. Citibank, 21. Bank of America, 11. 11. Wells Fargo, 4 out of 100. So basically, people hate their bank with a passion. And they absolutely love SoFi, and in fairness, Nubank. So the new banks, not the NU one, but the NEW ones, are doing something very, very right. Should that feed into valuation? Well, you say, maybe not, maybe not. Maybe people are still sticking with their nasty old banks, but really, it's a huge difference. Okay, and then I've seen this here also. Huge shout out to an account called Data Driven Investing. Give the chap a follow. He's amazing. I'm trying to get him on the channel as well. He does some great research on SoFi. And he summarized this better than I could have done, so I'm sharing what he's done here. What's the difference? What's the advantage over a bank? If you're comparing SoFi against Bank of America, first of all, your customers love you versus they want to burn down your bank. Lack of physical branches. So overheads are much lower. Think about the rent on all these things. Think about the staffs that are in there, the till at the cashiers. You have to clean them. You have to light them. You have to heat them or cool them. All that stuff. You don't have to do any of that, right? As SoFi. The bank charter, they're now a bank, yes, lowers costs versus other neobanks because other neobanks have to work with the bank to finance themselves. It's higher cost. And they're completely integrated. So they run the entire tech stack in-house. Unlike someone like Robinhood, for example, who I know isn't a bank, but they use SoFi, for example, for some of their back end, right? So this again reduces cost. And it's a one-stop shop. And because it's a one-stop shop, they bring in more revenue per customer because they can cross-sell them. Bank of America, not very good at that, right? When is the last time Bank of America called you with something useful? Probably never happened. And then, yeah, we got this ridiculously high net promote score. People actually love using the product, but that isn't enough. Have a look at where people are putting their money in the new banking space since Silicon Valley Bank collapsed, and Americans are quite rightly worried about bank runs and bank failures in the small and medium banking sector. I think it's a completely rational thing to do. And when did that happen? Well, that happened in the first quarter of this year. Let me put a line in here. What color are we not using on this chart? It's a fairly colorful chart. So basically that happened sort of there, right? Not the straightest line. So what happened afterwards? Well, Discover and Green and Lending Club here and Ally, all of their deposit growth, right, collapsed massively. You can see that, right? Red line, green line, yellow line, all collapsing because people are like, I don't trust these people. I don't trust these people. Who are they? Whereas if you look at SoFi, very, very, very consistent. Can we have blue, Microsoft? Please, pretty please. Funny people. Look at that line there, right? It's just a nice, solid, consistent growth of deposits, now almost $3 billion. And that says a lot again about the brand and people's trust in it, that they just think, okay, it's a solid thing. It's not like the latest thing like Ally was or something like that, but it's just like consistent. Now, there is more. Member growth is insane. Continues to grow every single quarter at accelerated rates. And it's not that they're just growing their members, but they're acquiring them at lower and lower costs. And we are going to get to the trading bit and how we make money out of this in a second, but it's important you understand what happens underneath the headlines, right? So the cost to acquire a new SoFi customer is now about $250. And that's the lowest it's been since 2021. Now, what happened in 2021, the fourth quarter, everybody was just like, it was like the boom of new banks and tech and everything else, right? So that's a unusual metric. So it's coming down here for the second quarter in a row. And because they are cross-selling, they're not selling them just one product. The cost of selling them the second product is basically zero because it's just an in-house cross-sell. So you go there and you get a student loan, and then they'll sell you the car loan, and then they'll sell you the home loan, and they'll sell you something else, right? Investment products, deposits, trading, and everything else. And that's what they're really, 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 really good at. Now, is it valued like a bank? According to Morgan Stanley, it should be valued like a bank. So let's have a look at Morgan Stanley. Morgan Stanley is a bank and has a price to book of 1.4x. What about SoFi? SoFi has a price to book of 1.3x. So it's cheaper than Morgan Stanley on a price to book ratio. What would that imply? Well, it imply maybe worse profits. Maybe there's a risk they go out of business. Maybe they're not growing as quickly as Morgan Stanley. Maybe Morgan Stanley is the place we should be investing. Well, let's scroll over a little bit and have a look at revenue growth, projected revenue growth from analysts who are pretty bearish on SoFi. So in my opinion, they are low-balling revenue numbers. And Morgan Stanley has a 2.8% per year expected revenue growth compounded. So it's actually lower, but compounded is 2.8%. SoFi, 23%. So it's like, what is that, 8x or something? 8 times higher growth rate, and the stock is trading at a lower multiple. Does that make sense to you? Doesn't make any sense to me. Now, you could argue, all right, well, they haven't got any profits. It's true. But Morgan Stanley's profit growth per share is falling 7.7%, whereas SoFi's is improving 45%. So they're moving in the right direction, right? Sure, they're not at Morgan Stanley's profit margins of 24%. No, they're at slightly minus, but that's because it's a startup and it's a new business, and they're going to get there in time. So that isn't really an apples in apples and oranges, you know what I mean, comparison. What is it? Apples and pears and apples, oranges and plums. something like that. You get the idea. So it's unusual for a company with much, much faster growth to be valued lower. It's normally the other way around. Normally you get silly valuations where it's worth 10 times on the basis of future growth. So is a stock cheap? I can't say that to you. It'd be financial advice, probably, if I did. But in my opinion, it screams undervalued. Is it risky? Well, do you think Morgan Stanley likes having a competitor out there whose customers actually like them? You want to give them money? And as Anthony Noto says, we steal deposits from the big banks. I think that's fundamentally why the analysts are not liking it. And I know analysts are meant to be independent, but well, that's just not true, is it? It's just not true. There is no Chinese wall within investment banks. It's all nonsense. Everybody has lunch together and, cocaine together and whatever it might be. Obviously not at Morgan Stanley. No. They are whiter than probably not the best analogy, is it? Using the word white. Anyway, I'm digging myself into a very, very large hole. Let's stop that. We'll just stop right there and edit out the previous bit, if I could be bothered to edit. So why do I show you this? Because growth companies, their biggest risk is management. Their biggest risk is leadership and ability to actually do the right thing. Now, El Presidente, Comrade Biden, stopped student loan repayments, if I remember correctly, the end of 2021. So for all of 2022, actually all of 2023, the biggest part of SoFi's business was nationalized in some sort of post-Soviet communist takeover coup. And you might say that was the right thing to do. Maybe it was, maybe it wasn't. But just from an investor point of view, it's a pretty unusual thing to happen. So SoFi's core business was basically frozen. No growth whatsoever. And what did they do? Well, they beat their own revenue expectations every single frickin' quarter, more than if the student loan business had been allowed to grow. And their earnings per share were also a consistent beat, 0.01%. 1 cent is pretty irrelevant here on those two. And those were, the bloody hell, our core business is just shot down by Washington. So it says a lot about management that they managed to get through that period, still beating market expectations, as if their core business wasn't affected at all, when their core business was just, shambles, crying in the basement. So shall we look at a trade? 150% return trade, big promises here. Now, that's if you keep doing this trade repeatedly. There's just a bit of a disclaimer there. What do? You go to optionswatch.io. I'll put the link down below to this trade. Now, you need to sign up to it, and you can do that here somewhere. And there is a 30-day free trial. So take advantage of that because it's glorious, it's free. And then at the end of the 30-day, you may or may not like it, but 70% of people who sign up for this, for the free trial, stick around and stick to it because it's that good. And how do I know that? Me and one of my students are the ones developing this. Well, I come up with the ideas, so they do the hard work. And I go, can we do it faster? That's really what we do. So what's the trade idea here? So you've got a stock chart here. You're familiar with that, right? So I'll just put in a 200-day moving average line there, a 50-day moving average line here, and you can see, we're going down. We're well below it. So what do? Well, say we're fundamentally bullish this company. You don't want to buy the stock because it's bloody risky. And it's actually a terrible idea right now. It's a terrible idea to buy pretty much any stock right now. Why? Because options are so cheap. It's like a 4-year low on the price of options. So you could just buy a call option. But if you did that, you have like a 30% chance of making money. It loses you money every day. You hold it. It's just not really a great setup. So what we could do instead is set up something that's called a bull call spread. And you can select that from the drop down up here on the top right. And if you know nothing about options, just listen to it. Let the rain sort of run down your face and you will absorb some of the wisdom that is in that rain. So this trade has a 74% chance of making us money. It sets you up at $5.80 with a break even. So you're not essentially buying the stock at $6.80, but $1 lower. And that's pretty cool. And that's because, well, it makes it a lot more likely that you'll make money, right? Because you're not sitting at today's share price. You're sitting, what, 15% below today's share price. So let me zoom in a little bit on this. So what have we done? So from an execution point of view, we've sold a $6 call and we've bought a $5 call. And we've done that with January 19th expiration. Now, January 24th, I believe, might be the NEO earnings, the 24th of January. So that's why we did it just before, because that's a risky event. We don't want to be in it. But what it really does is it creates, let me use a different color pen here. That's where the stock price is. That's where we are, the lower line. So this area here, that minus 15% drop in the share price is our basically safety zone. So we can be wrong and we can still make money. Now, should you do this trade if you don't understand it? Heck no. Because you need to understand assignment risk, you need to understand how to manage it, how to adjust it, what your trade rules are to exit. And I will teach you literally all of that for free tomorrow if you come and join me, felixfriends.org/webinar. It's not on YouTube. Try putting it on YouTube. The algorithm puts me in the naughty corner for about 10 days because they're like, nobody wants to know this. But the 7,500 students I've taught this want to know it because they're making a killing. So that's the sort of thing I do. And, you know, this makes you potentially a 22% return. If you rinse and repeat this every month, you make a really, really nice return potentially, right? So there we are. Not financial advice, but sort of setup that I would do in an environment, taking advantage of really low volatility. Because most people don't understand volatility. Options is what drives half the market. There are 2 million options open on SoFi. That controls 200 million shares of SoFi. So if you are in SoFi and you don't understand options, you don't understand what drives the thing. So come and learn it with us. It's actually fun. It's actually really, really good fun once you get into it. So here we are again. felixfriends.org/webinar. And just sign up, grab a seat, get yourself, you know, some popcorn, lean back with a notepad, and I'll walk you through it slowly, bit by bit, step by step, how we automate the trade setup, how do we automate the execution, the risk management, all of it, stop losses, all that good stuff to make sure that we have potentially the highest outcome with the least amount of risk. And yeah, anybody can do this. If you've got a couple of hours a week somewhere, lunchtime, mornings, evenings, weekends, whatever, you can do this, and no knowledge required. Come and join me. I appreciate you watching and tuning in. And if you enjoyed this video, then well, sign up here and smash the you know what, and possibly even share this. Who knows? Share it somewhere. Thanks for watching.